Hello, Wealth Nation. I'm your host, Meetu Bhatnagar, and today we have a very special guest, Anton Matli. He is the CEO of Peak Financing. Hi, Anton. How are you doing?
Hi, Meetu. Doing great, thanks. What about yourself?
I'm doing great, thank you. Anton, our listeners would love to hear your story, what you do, and why do you love it?
Yes, sure. So I'm a co-founder and CEO of Peak Financing. We arrange financing for commercial real estate across the country with a focus on multifamily properties, primarily in, as we call it, the middle market segment, typically property values from 2 million up to around 50 million. Above that, while we do some of these transactions, it's mostly institutional investors that handle that. And they are large enough to have their in-house staff handling the financing, whereas the other buyers that are in that, as we call it, middle market segment tend not to have the in-house resources to properly find the right financing solution and then also get them through the process all the way to closing.
Very impressive, very impressive. Anton, our listeners are mostly beginners who are just learning to invest in real estate. We will appreciate if you can please throw in some light on the financing for a very basic beginner.
Yeah, sure. So I started out also on the investing side, on the small side too, right? I like everyone, so I think the benefit I bring to the table and our company brings to the table that we have also investment experience. A number of our debt advisors are also property owners, and so we understand what the buyers go through, particularly new buyers go through. So I think we bring that additional benefit to the table, and we can coach them what to look out for when they're looking for financing, particularly for the first deal. Someone who comes from the single family space, right? Someone may have been very successful and that's been doing it for a long time, buying and renting single family homes. But obviously in that segment, the way a lender underwrites a transaction is very different. It's mostly driven by the personal debt to income ratio. The property's cash flow, once it's seasoned for 6 or 12 months, might count a little bit towards that, but it's still primarily the personal cash flow and credit scores, obviously, that really drive the decision for a lender to make to say yes or no to a particular loan. Whereas on the multifamily side, as well as any other commercial real estate, it's a much more complicated process one has to go through, where the property cash flow as well as the sponsor net worth and liquidity all come into play. And I think that is the key challenge for someone who starts out, that they are able to mentally make that shift from that single family approach to the commercial and multifamily way things are underwritten from a lending perspective.
Okay. So, what is recourse known and what is non-recourse known?
Yeah, that's a good question, particularly when you come from the single families area, right? Everything is recourse. You always personally guarantee. On the commercial side, when you go to a bank, very often it's a personal recourse, so you personally guarantee, and if something goes wrong, even just operationally, you're still fully liable. With a non-recourse loan, if things go wrong from an operational perspective at the property, and the property can no longer service the debt, and in a worst case, the lender has to foreclose on that property, then you as the guarantor, even though it's still called a guarantor, but it's a non-recourse guarantee in a way, you are not responsible for any additional outstanding balance after the foreclosed, as long as it is operationally driven, right? So there are certainly some elements that one needs to realize, even though it's a non-recourse loan, there are always so-called bad boy carve-outs. So you still have, if you commit fraud, which is quite obvious, then that shield of a non-recourse will be breached and you're personally liable. Fraud is obvious, but it's also gross negligence, and that's where it gets a little bit tricky, where if you forget, right, to renew your insurance, you commit gross negligence, right? So
Absolutely.
so
I
there
agree.
are some elements in your operations that can trigger that personal recourse relatively quickly if you're not a good asset manager, right? And I would say that is really the key piece, that you do not commingle funds, that you stay on top, that everything is done properly, that you meet all the clauses of the loan agreement. And obviously insurance is one of those items, but there are other clauses. And when you read through that guarantee, you will see a lot of items that are actually part of that so-called bad boy carve out. So it's very important to clearly understand what potentially could trigger that bad boy carve out.
Okay, sounds great. Oh, you just mentioned about something called the commingling of funds. Some of our listeners, they might not be aware of it. So what exactly is commingling of funds?
Yeah, so if you own multiple properties, and that's usually what can happen relatively easy. If you have an operating account at one property, you should not really move those funds to another property. When you feel, well, I have a little bit of a shortage on my cash position in that other property, don't do that. Also, what happens quite regularly when people do capex rehab work, that sometimes it's all tossed together when you have multiple properties and the same property management company, and very often these funds are not clearly allocated to a particular property. And frankly speaking, sometimes even the property management company does not do a good job in clearly dividing the funds among each property, particularly when they handle multiple properties for a particular owner. So it's just very important that all these operating accounts, as well as capital reserves, capital expenditures accounts, that they're all clearly separated, and that our funds are not being moved from one property to the other and vice versa.
Gotcha. Thank you. Do we really need to have some experience when we go for these non-recourse or agency loans?
Unfortunately, today it's almost a given. In the past, with Freddie SBL, it was possible to get into these loans without any prior experience, as long as you had a third-party management company that did the property management. But Freddie Mac has tightened up those rules quite significantly. So while that was possible maybe a little bit more than a year ago, now you essentially need 3 properties for the last 2 years that you have under your belt from an experience perspective. And for on the Fannie side, it's 1 property over the last 2 years. And when we talk about properties, really similar size properties, obviously, if you have a 10 unit and you want to do a 100 unit or plus, that 10 unit doesn't really count as an experienced operator, because the size difference and the way, as you know, to run an asset management for the 10 unit is very different from a 100 unit. So that is important to recognize, particularly when someone starts out. But the advantage is, and that's clearly a major benefit in the commercial environment, including multifamily, unlike on the single family side, where you are the lone warrior, right, that has to do everything, and it all depends on your cash flow and your own personal financial strength. At least on the multifamily side, you can partner up with someone who has not just also brings the financial strength to the table, but also, for to answer your question, that experience, right? So if you do not have it, partner up with someone who has, and then you will qualify.
Awesome. Sounds great. So if I have a portfolio loan, right, there are four different properties, but that's a combined one loan. Will it qualify as that requirement or no?
When you have a portfolio loan for Freddie SBL, you mean, or
Fanny, yeah,
yeah,
Fanny.
it depends. For Freddie SBL, you can have so-called scattered site properties as long as they are within a reasonable distance, 1 or 2 miles from each other. As long as they're also of similar quality, similar age, right? So they all should kind of be a good match to fall into the same loan. So that is definitely possible. But it also comes at the cost because the interest rates are higher with those. So I would say if a property, in each individual property is large enough to qualify for an individual loan, in most instances, you're probably better off to go with individual loans, right? There are when we come into the institutional space and really large players, it's not uncommon to have these large portfolio loans. But then we talk about 50 million plus as a loan amount. When we talk about these smaller type of loans, again, it can be done. But very often it tends to be, as long as each individual property qualifies, it tends to be better to just have separate loans on each of them.
Makes sense. Sounds great. What is KP? Does it make sense for me to sign on someone else's loan? Is it beneficial for my resume? And how does it work?
Yes, so it's only when you want to start out and to build up, right? So some people call it the Fanny card or the Freddie card, to get onto a loan as a guarantor. That's only helps to build that so-called experience with Fannie and Freddie. Now, I personally would not recommend to do that strictly as a passive investor because you are, as I mentioned before, even if it's a non-recourse loan, you still depend on the GPs, the sponsors on this deal, to do the proper thing on the asset management side. So I personally would not really feel comfortable to be a passive investor and still guarantee that loan. Some people are, right, and that's, everyone has a different risk appetite. But I think it's even if someone does that, be aware that you do not really have access to all the information as the GPs do. So if something goes wrong, you are in a tougher position really to step in. So if possible, I would say if someone wants to be a guarantor in a deal, I would recommend to become a GP in that deal rather than just being a passive investor. Now, if someone says, okay, I want to be a GP, then I would say just choose your partners very wisely, right? Even if you are, yes, you are, maybe you're involved a little bit in asset management, in due diligence and all that. You may not be as actively involved as some of the lead sponsors, but just remember, it's a marriage that will last probably 3 years at minimum, possibly 5+ years. So it's a long time, and you need to feel comfortable with everyone on the sponsorship team.
Sounds great. How is the financing looking today in COVID-19 in the pandemic world?
On the multifamily side, I would say it looks better than in every other commercial asset class, except maybe for logistics properties like logistic warehouses. They are still pretty easy to finance because they are just on fire, as you know. Uh, but any other commercial real estate, it's much harder to get the financing in place. Multifamily, primarily thanks to Fannie, Freddie, and HUD being readily available to provide financing, as well as the fact that multifamily properties have performed much better than everyone anticipated. Yes, we have some stress points in various submarkets and some properties, but overall, multifamily properties have performed much better than what everyone anticipated last March and April. So that all combined really has helped for the financing side to continue to be really readily available at very attractive terms, right? So the only caveat there really is that lenders are certainly a little bit more conservative on the underwriting side. They are on top of the most recent collections, bad debt, physical occupancy. So they certainly monitor it much stronger than ever before doing the application process, even after you applied for the loan all the way to closing. So you have to be aware of that. And apart from the underwriting side, it's also the as everyone all has heard, and whoever has done a deal has complained about, is are the principal and interest escrow requirements. That's the disadvantage, obviously, that you have to put in for a full leverage loan anywhere from 9 months on the low end to all the way to 18 months in principal and interest. So that is definitely a negative. But personally, I would read it more as a safety net for you as a sponsor, as well as for your passive investors. Yes, it obviously you have to raise more equity, but you also improve the risk profile of your deal, right? So I would say that's the way I would communicate it to investors. Yes, look, the return may be a little bit lower here, but our risk profile also has come down because we have 9 months, 12 months, 18 months, whatever it is, in principal and interest with the lender. And that's a pretty good cushion, right?
Sure, sounds great. So there are like two kinds of, one is fixed rates and one is floating rates, right? What is the difference between the two, and what should I prefer?
Yeah, the difference is pretty easy to explain, right? So if you have a 10-year loan, the fixed rate, you lock in the rate before you close the loan, and that rate is not going to change all the way through over the next 10 years. Whereas with the floating rate, you go into a, as it says, floating rate or adjustable rate, and that rate is going to adjust throughout the whole loan period. So you may start out 3%, but it may move up to 4%, maybe 5%, maybe even higher. Now, there are protections that floating rate lenders will you required to do, which are called interest rate caps. So if you take out, let's say, a Freddie floating rate loan today, while you may get that 3% roughly rate, starting rate in place, the lender obviously is concerned that if short-term rates move up, then you would have to pay a higher rate, and that's why you, outside of the loan, you would have to buy a so-called interest rate cap, which essentially protects you from a massive rise in interest rates. So that's how you can potentially protect yourself. Now, the question, your question, which one is the better one? Right now, the floating rate is only the darling for a lot of investors. And the reason for that is that anyone who has taken out a loan in particularly 2018, but even 2019, 2017, and has seen a massive appreciation of their property in terms of value. They have a lot of prospective buyers that want to buy their properties. They now realize, because they did a fixed rate loan, very often with yield maintenance, that the prepayment penalty on these loans sometimes is 30% plus of the outstanding loan balance. So all the equity that they have created essentially would be eaten up by that yield maintenance. And unfortunately, on top of it, the interest rate on these loans tends to be higher than what the interest rates are today. So the buyers that want to buy these properties are not really that attracted to take over a loan that is at 4.5% or maybe close to 5%, sometimes even more. So it has put the sellers or these property owners in a very difficult position. In the past, the view always was, well, someone will happily assume the loan because they can put a supplemental on top of it. And because interest rates have dropped so much, these no longer look very attractive, right? So now the key question is that still going to be the situation today, right? Because now we start out at a much lower interest rate, even if it's a fixed rate loan. Let's say it's somewhere around the 3.5% range. So now the question is that, do we have the same risk? I would say the risk is no longer the same because you only have so much lower where you can go from a treasury perspective. So I would say going into yield maintenance loan today is not nearly as risky as it was back in 2019 when the interest rates were 5%, right? And the treasuries was still well above 2%. Having said that, it still puts you into a less flexible situation. So an alternative with a fixed rate loan over a floating rate where you have that full flexibility is to pay more and go in with a step down prepay, even though for a conventional fan you may pay 30 basis points to 40 basis points more as an interest rate. At least you know at any given point how much you would have to pay for a prepayment penalty. So I would say in the current environment, if you want to stay flexible, if you feel, look, I may be able to sell in 2-3 years, I would say definitely go with a floating rate loan, or as an alternative with a fixed rate loan with a step down prepay, even though the interest rate is obviously substantially higher. A yield maintenance, I really would only go in there when you have truly the intention to hold a property 5 years, 7 years plus. Now, everyone says, well, we're holding it for 5 years, but the problem is as soon as they realize that the value has gone up so much, then they want to sell, and then they are stuck with yield maintenance, right?
Absolutely, unless someone assumed the loan.
Unless someone assumes the loan. Now, solely today, I would say the chances that someone feels that the 3.5% yield maintenance loan in 2 or 3 years from now is attractive to assume, the chances for that are much better now than they were when someone took out a loan at 4.5% to 5% 2 years ago, right? So at least I would
Gotcha.
say the chances are certainly better. Particularly, I personally believe that treasury yield will move up over the next 6 to 12 months. So I do not really believe that the fixed rate loans down the road will be much lower than where they are today. So I think even if they drop to 3%, let's say, back to 3%, the difference is not that substantial. So that 3.5 yield maintenance loan may not look that bad for someone to assume in 2 or 3 years from now.
Got it, got it. What is yield maintenance and why do lenders put that?
Yes, yield maintenance essentially means that once you get into that loan, we expect as the lender, and it's not really the lenders, it's the investors in that loan, right? All these loans are essentially funded, then packaged together and sold as a bond in the market. So you could do a loan and you could buy a Fannie or a Freddie bond, and your loan will be in that bond, right? So there are investors out there that buy these bonds that have multiple loans packaged into them, and as part of that, these investors are promised a certain return, and as a result, that yield maintenance essentially says if you have a loan, let's say at 3.5%, you will need to pay the lender and by extension, the investors in that loan, that 3.5% through the life of the loan. So if you want to sell that property or refinance the property, let's say if it's a 10-year loan in 3 years from now, you would have to pay that 3.5% all the way for the remaining 7 years. Now, you do not have to pay the whole 3.5%. They will look at what is the risk-free rate for the remaining term, which is generally the treasury yield for that remaining term. So you will pay the difference between that rate that you have agreed, let's say 3.5%, and the 10-year the treasury yield strip for the remaining term. Let's say it's at right now, obviously it's very low, but let's assume it's still at the same rate at roughly 1%, just to make it simple. So you would have to essentially pay the difference between the 3.5% and the 1% all the way to the end of the loan. So you would have to pay 2.5% on the remaining balance for potentially 7 years.
Wow, sounds great.
Yeah.
What is bridge loan and how does it work?
Yeah, bridge loans are coming back a little bit with before COVID-19 hit. Bridge loans were everywhere because a lot of hedge funds entered that space, banks entered that space, agency lenders provided bridge loans. So everyone was jumping onto bridge loans. So they were extremely aggressive, readily available. With COVID-19, the whole bridge market essentially collapsed for a couple of months. And it has come back, luckily, but the ones that are back are a little bit more picky, which properties and which sponsors they want to finance. A bridge loan makes sense when a property is really distressed, when you are, let's say, at 80%, 70% physical occupancy, and or economic vacancy is really bad on top of that. So you buy the property and you come up with a pro forma that is typically a 3-year plus pro forma. And based on that, the bridge lender will assess whether your pro forma is achievable and finance that property acquisition with the expectation that bridge loan then can be exited into a permanent loan like a Fannie or Freddie or whatever the program might be 2 or 3 years down the road. So it is important always to think that the bridge lender will underwrite to the assumption that your property can be stabilized and that you will be able to finance based on that stabilized pro forma into a fixed rate loan at that point, right? So your pro forma that you put together will be absolutely crucial. Your capex expenditures that you plan to put into the property will be absolutely crucial.
Sounds great. Today we are in an entirely different world, right? We never imagined this pandemic will happen and it will affect us, right? So along with everyone, there are few sponsors, right? That even though they are not at fault, still they are not able to perform, right? They cannot evict the tenants because of that, all the moratoriums and the CDC compliance, right? So how forgiving will be the lender to these sponsors?
Yes, so back when it all started with COVID-19, right, we had forbearance options where borrowers could apply for forbearance, but it was really required to show that the property has become distressed due to the COVID-19 situation. What lenders really did not like is that people applied for forbearance when the property was already in distress before, right?
Yeah.
But some still applied for it and they received for forbearance. Now, the problem is that most operators that are already were struggling pre-COVID-19 and right when COVID-19 started, they tend to be weaker operators, and forbearance really hasn't helped them that much, right? Yes, it has helped on the loan side, but unfortunately, very often the property hasn't really improved that much. And I would say many of those are still in a pretty tight situation. Uh, Now, what can be done today if you're in that situation? Just talk to your lender, right? If it's a bank, it's much easier to talk to them. If it's an agency lender, it's much harder, right? Because agency lenders, all these deals, as we discussed before, they are securitized, so they have very limited flexibility to accommodate you, right? So now, obviously, they do not want to foreclose on that property at whenever possible. So it's not that they immediately say, now you're not meeting our requirements, now we are foreclosing on you. So first you go on a watch list, then you go likely on a Fannie and Freddie watch list. And at that point, you likely will have to bring in interest reserves, right, to cover the gap of where your property underperforms. Now, the problem for a lot of operators is that they may not have those funds, right? There is a reason why they already have been struggling before. So, unfortunately, in those situations, you have two options: you sell, or you raise more money so that you can put in the interest reserves that the lender requires, and or also finish your capital improvements that are necessary, right? The problem is, and we have not seen many, particularly syndication deals where that was successful. If you already have a property that is in distress, it's very hard to go back to your investors and ask for more money, do a capital call, right? So unless you as a sponsor have the ability to inject more equity, you're really in a tough spot. And what we see in those situations, that they essentially go to the market with that property and hopefully are able to sell without losing any money for their investors.
Gotcha. Anton, you are such an accomplished man, right? And you are equally good at heart. So, how do you give back to the community?
Yeah, we do it in different ways. Obviously, in the multifamily community, we do a lot of education. Right,
Mm-hmm.
we are in all over the place, helping uh, investors and syndicators to understand how to buy these properties, how to finance properties. So that's what we do in our little world of commercial real estate. Outside of that, we are and particularly because we are very actively involved on the multifamily side, we understand that a lot of tenants that are our clients in a way, right, that pay our bills ultimately. Some of them are in distress themselves, and very often they are in distress not due to their own fault, right? It's not. Some of them are lazy, but plenty of them are not lazy. It's just it's bad luck, and they have a hard time. So we are supporting an organization that happens to be in McKinney. It's a Samaritan Inn that is a homeless shelter that houses whole families. But it's not just housing the families and give them food and give them shelter. A big part of the program really is to teach them how to get back on their own feet and go back into the job market, finding a job and whatever else needs to be done, so that they are no longer dependent on the government or on a shelter. And so that's where we kind of tying it in with all that multifamily activity, where we try to help the tenant base that is struggling for the properties that we finance.
Sounds great. Thank you so much, Anton, for adding so much value to our listeners today and for everything you do to make this world a better place. How can our listeners reach out to you?
The easiest is by email. It's Anton, Anton, at peakfinancing.com. I'm also very active on Facebook, on LinkedIn. Now the newest thing, as you may know, is Clubhouse. So I'm active there too. We are co-hosting rooms talking about multifamily and other commercial real estate. So it's search for me on Facebook, LinkedIn, and you will definitely find me or send me an email.
Thank you, Wealth Nation. Until next time, live a life filled with freedom, fun, and fulfillment. And we will meet again in 2 weeks. Thank you.